Okay, this says I'm live. Where's my counter? Okay, it's counting. Let's wait for confirmation from YouTube before I begin. I appear to be live, but no confirmation. All right, I will just assume that I am. Let me scroll to the bottom. All right. I didn't get confirmation that I'm live, but there's my confirmation. I'm live. It seems to go to 30 seconds and then it resets and then it tells me I'm live. So I am live. Let's just jump right into the questions here. Is it too late to get into CapREIT at this point? I don't think it's too well. I guess I would ask what your holding period is. If you say 3-4 years, then no, it's not too late. Or Canadian REITs in general, I don't think it's too late. You've missed a big part of the move. You've missed the undervalued. The biggest part of the undervalued move. CapREIT at 43 was, I think, massively undervalued. We knew rate cuts were coming out of the Bank of Canada. Why the REIT didn't price that in to begin with, I don't know. Maybe too many eyes looking at tech stocks, communication stocks, and not enough looking at the boring sectors like utilities and apartment REITs. Why they were undervalued that long, knowing we have rate cuts coming in, was curiosity. But it's doing well. I think it'll continue to do well. It depends on what your strategy is with CapREIT. If you know how to work the options, it's never too late. If there's such conviction behind falling rates, why not move into EDV instead of TLT? EDV duration 24 versus TLT duration 16.7. You can reach for more duration, sure. I would be concerned about liquidity and options availability and liquidity in the options. TLT has all of that. Current thoughts on Fed policy reaction function and how the Feds are behaving collectively. Does your belief of where the neutral rate is differ from the Fed if we do achieve a soft landing? I think they're cautious. I think they're collectively cautious. I think if they didn't meet in the same room and they just had their own staff consult with them, I think you'd get a lot less consensus. But Powell has explained this before. They have one-on-one meetings well before the FOMC, and they try to achieve consensus before the meeting. So the meeting is almost a formality at that point. They're cautious. They're cautious because nobody wants to repeat the errors of the 70s. I don't know if they recognize this isn't the 70s anymore, but they're cautious. Neutral rate, I think the neutral rate is higher only because of the level of financial sophistication, but I don't think we ever need to get to that level of neutral rate. I think because of the amount of technology and the progress in technology is deflationary. So because you have that backdrop going on, I don't know that you could ever raise rates or ever have a need to raise rates to the point of hitting a neutral rate. But I do think it is much higher than it's ever been. I don't know what it is though. IB refused my application for an options account. It's odd. How many years of options trading experience? I said I have 0. Well, you'll get refused if you say 0. I entered 1, said inadequate. It's enter 5. It's sort of a cover your ass question. They're just asking you how many years of experience you have. You tell them 5. This means that if you mess up, you can't you can't hold them responsible for messing up by saying they let me trade options even though I had no experience. You said five. That's your own fault. They're not going to ask you to prove it, right? They're just covering their ass. So just say you have five. That's okay. Please quickly explain buy to open. Well, I don't know that needs any explanation. You're buying something to open a position. Sell to close. Again, I don't think that needs an explanation. You're selling something to close a position. Sell to open, that means you're selling a call or you're selling a put as your opening position. Sell to open uncovered means you don't have the underlying. Buy to close covered. Well, I guess if you sold to open, I don't even know what the purpose of that would be. Yeah. Will there be sector studies for high-end fast food chains like Chipotle, Cava? In time, I'm one human being, so I can only get so much done. But in the sub industry videos that I do, you should, after watching 5, 6, 7 of them, you should see how they unfold. So that if you were going to do one on your own, look, you don't have to wait for me. That you should have, a list of questions that you would want answered, and then it's just a matter of reading 10Ks. Company 10Ks will give you a lot of information. It's a matter of different Google searches, different papers that you could find. There's all sorts of information. Maybe there's an industry association that has a whole bunch of information as well. So it is, you're a detective and you're just trying to get the answers to questions you have. So draft up your questions first and then be a detective. Go find answers to your questions. You don't actually need to wait for me. If you're consistently just waiting for me to do this or to do that, then you're not learning from the process, which means you're not picking up the process yourself, which you should over time, right? What do we got? Sold $9 puts, $8 calls. How is this strategy is called? It's like a short strangle, but it's the put is in the money, but it's kind of a, instead of strangling the stock, I strangle the $8 to $9 price. I don't know that it has a name. Is this better than a short strangle? For what I'm trying to get done, yeah. If I did the 8 put and 8 call, or sorry, the 7 put, actually the 8 put, the 9 call, because it's around $8. The 8 put and the 9 call, I don't get the same premium. I don't get the same break evens. It's actually lower, which to me seems odd that it would be that way. I even had somebody here and I showed them the premium. I said, how can you explain this? Oh, shouldn't it be relative? And it just seemed like easy money to make. If Goodyear stays between $9 and $8, it will be both put and called away from me. In other words, I'll make, what do I get, 175 and 180 something, 184, 177. So the buck I lose because it's put and called for me. But you make 84 cents easy on 177 on the other, if it's between 8 and 9. So that does a lot to lower my average price. If it's called away, it's called away. If it's put to me, it's put to me. Heads I win, tails I win, sideways I win. I win no matter what on that one. How do you decide the cutoff for closing your GM puts? So if you look at how much premium was left over, divide by the amount of margin you still have to leave, because you still need margin. And then you just annualize it. So December's 100 and some odd days away. Uh, so they didn't make any sense. There are other places I could go. It just seemed that it was. Now, mind you, I'm not cash constrained, so I could have stayed in them, but the return on the invested capital wasn't really that great. GM had a really good run along with the rest of the market. Um, I don't know. I felt comfortable taking them. I'd made a lot. Plus, I got aggressive on the way down. It was probably more puts than I should have, but you see it at 41, then 40, then 39, then 38. It's hard just to sit around and say, well, I'm not going to take it. If I was a buyer at 46, I must be an incredible buyer at 39. Um, I only started selling them because GM started falling. It's not as if I said, if on earnings GM stayed at $51, I would never have sold those many puts. So I closed them after the event was over. I will see where GM finds a home. I mean, it released some information Thursday about Cruise entering the Uber platform. Let's see if that sticks. Let's see if it sticks with the market. If it doesn't, GM could give some of that back. If it stays, well, I made the money I went in to make on the reason why I went in to make it. Have you heard of Stephen Bavaria's Income Factory? No, not really. There's a lot of people out there with a lot of strategies. It's hard to keep up on all of them. That you bump into one or another is just a matter of where you happen to be searching at the time. Don't know the guy. Selling cover calls on TLT at 102, 103 based on only one jobs report between now and then, along with a cautious Fed. Is this decision due to FOMC being so close, or you believe jobs data is not that bad? I think the jobs data is going to come in line with all the other jobs data. I don't think. Basically, I guess what I would bring it down to is, I think the jobs data will not give the Fed a clear window to 50 basis point cut, which means being that they've been cautious for so long. I think they'll side with 25. They'll start the rate cutting process, but why start with 50? That kind of suggests that, well, maybe we were late. If we hit 50, the market will think, oh, we should have gone 25 last time and we didn't, so we're now trying to play catch up. Or that we see something that other eyes can't see. It's worse than I don't think they're going to do anything to alarm the market. I don't expect much out of the PCE report this Friday that would change any story that we have. And you have one jobs report and one inflation report before the decision. I don't see either one of those two reports clearly giving the Fed an open door for 50. That's why I think that a little too much has been priced in right now. I was right the last time I sold calls. Last time TLT went to 99, threatening 100. I was right on that. I still feel that I'm right on this one. If not, well, then some of my TLT will get called away at 102 or 103. Okay, that's fine. I can sell puts at a higher price to get back in if I want, or wait. There will be another down day on TLT. There will. I don't know when, but I'm not abandoning duration. I just think it's a little too much too soon. And I think that the 102, 103 calls is, for me, I believe it to be free money, right? I based on my belief, I don't see it as a risk. I see it as leaving money on the table if I don't do it. Why not? Why not roll your GM short forward with higher strike price instead of simply closing your December contracts? Well, rolling them forward, one part of it is closing your contracts. The other is opening other ones. So you could say I did half of that, but December's too far away. The reason I did that was because of the skew. The reason I did the strips for December was there was really good skew in it, and I went in for the volatility trade, not because I really cared to have them. Um, I don't think GM gets to $32, and just wasn't a lot of premium left for the capital for the amount of time. The annualized percentage wasn't that great. Have you already did that one? Did that one? Did that one? How and when you got into investing and trading? Oh, it's a long time ago. When I understand you were an entrepreneurship professor before founding MM. Yeah. Did you have any experience with trading before MM? Oh yes. Oh yes. Geez, I don't know. So long ago, I don't really remember what I was doing. Well, I mean, I know I was in the market. I didn't have the benefit of having good mentors at the time or being in a good environment for that. So you learn a lot by trying different things. And the first strategy that I did very well at was momentum trading, using nothing more than the 52-week high list. I had certain rules for what would be included, how many times a stock would have to appear on the 52-week high list. So it eliminates a whole bunch of stocks. Excuse me. So it eliminates a whole bunch because over a certain price, I wasn't willing to entertain. Below a certain price, I wasn't willing to entertain. Preferred shares, you just get rid of any preferred shares. So you had a price range, and you found stock, and you had my spreadsheet, and I would update it every day based on the list. And when I got 3 times in a 5-day rolling period, it automatically went into a buy. I simply just bought them. That worked out very well till momentum no longer worked out, but it worked out very well. That was my first strategy that I used. Minimum fund requirement for selling puts in IB, $2,000. You need a margin account. You need a minimum of $2,000 for a margin account. Acquire a margin account with level 4 minimum fund size of 100K. Is this true? I can't speak for every country, but in Canada and the US, it's a margin account is a minimum of $2,000. If you're going to day trade these things, I believe the minimum is $25,000. If you're going to be classified as a pattern day trader, you would need a minimum of 25,000. Carry trade fundamentals. Let's say if a person wants to buy a home instead of taking a loan from US, which is now 6.25 30-year interest, why don't they borrow from it? Well, first of all, borrowing from yen doesn't mean that you can use that yen. If you borrow yen and you want to be able to have full use of the funds, you're not going through a dealer, you're going through a bank. And you're getting a bank loan. You're probably not in any position to borrow from a Japanese bank. Number 2, you have currency risk, big currency risk, and your carry is in an illiquid asset. So if the yen strengthens, you have no choice but to pay more and more and more and more. Your house could end up costing you double. If the yen goes back to 2010, 2011 levels of below 80 from 140, right? You don't want currency risk for what you're doing there at all. You got 6.25. You want a decent enough mortgage right now. I would get a floating rate mortgage, which means you'll pay the higher interest. And then in October, after you have a 25 basis point cut, your interest rate will drop as rates drop. So I just get a floating rate mortgage, and in a couple of years, when you feel fixed rates are low enough, roll it over into a fixed rate. Do you agree that working in risk management is better than investment? For someone who focuses on critical thinking and logic and wants to avoid luck, future forecasts associated with investment and no, no, I wouldn't say that. If you don't have to have a forecast of where something is going. There are certain things that we can say with very high probability. Where is the S&P 500 going to be somewhere in the next 10 years? Somewhere in the next 10 years, it will be higher. Where? I don't know. There's something I know. It will be higher. Another thing I know is S&P tends to have a fairly constant yield of either between 1.7 and 1.9% on the dividend. Fairly constant yield. So I'm going to get paid. It has fairly liquid options so that I know I can manufacture another dividend on top of that. So I can go from a 1.7% yield to maybe a 4% yield, playing it very conservatively. 10 delta or 15 delta options, I can probably manufacture, double the dividend. I know that. So being that I know that, and I know that sometime in the next 10 years it's going to be higher, I don't have to forecast anything. I simply just know that that's really what's going to happen. If we think inflation will be 2%, if the Fed is interested in having 2% inflation over time, that means earnings, even with no real growth, earnings will rise at the level of inflation because earnings are nominal, which means prices will rise at the level of inflation because prices are nominal. So I have that kind of inflation protection there. These are things that I know, not 100%, but very high probability. I don't have to worry about forecasting. So if you can go through a 10K and you can say, you know what, if the economy is doing well, if the S&P is doing well, this is going to really do well. This one's going to do better, I think, than the general market. And if you can do that, you just need a good story of something. You need to be able to spot something that's undervalued. You don't have to actually have a forecast for where it's going to go. So no, I don't think you need to be in risk management to avoid luck. Now, there's nothing wrong with luck when it comes along, I'll tell you that. When you're talking about adjusting by cash and fair value of assets, do you mean doing an enterprise value to earnings ratio instead? Well, it's in comments, it's hard to answer questions like that because you may have a picture in your head of what you mean with enterprise value. I may have a picture in my head. If you have a business, let's say, and you sell your business, you're selling the franchise of your business. If your business has a whole bunch of cash sitting around, the cash has no multiple. You're not going to pay a multiple of cash. So usually when you sell a business, at least a private business, you'll get a valuation for your business X cash, which means you get paid and you strip out the cash, you pay off the debt, but you strip that out. Because they're buying the franchise, not a pile of cash sitting on your balance sheet. Well, cash levels of the S&P 500 are quite high. So if we're just looking at the earnings and we're looking at the valuation and saying, well, it's 22 times forward earnings, we might say, but hang on, though. It's not as if that cash is free. That cash is going to add to the value of the business. So the market cap of the business will be the value, the franchise value associated with the equity plus cash. So if you adjust for cash, let's say a company it makes $2 a share and is trading at 30 times earnings, is trading at $60, but it has $6 a share in cash. if you adjust for cash, it's really trading. The franchise is really trading at 24 times earnings because the cash is worth 6. You're not going to pay a multiple of cash. Cash is cash, right? Now, think about historical cost on assets, especially real estate. One of the reasons Sears never went to zero, even though the franchise was worth zero, Sears never went to zero because it was sitting on a whole bunch of real estate that was worth a hell of a lot more than what was on the carrying value of the balance sheet. So you could basically buy Sears and throw away the company, and you're basically buying the market value of the real estate. So a good example of this, we'll be doing Costco for financial modeling. Costco owns outright 677 land and building, 677 of its 800 and what has it got now, 890 locations. And it has leases on a whole bunch of others, predominantly land leases. So it has a whole bunch of real estate, but it puts it on its balance sheet at historical cost, and it depreciates it over time. Rough estimate, the carrying value of the real estate is about $100 billion lower than it should be. So if you take their market cap of 380 billion and you lower it by the 100 billion, well, if you'd lower it by 80 billion because it's listed at 20 billion. If you say it's 100, lower it by 80 billion, it has a market cap of 300 billion. So if you adjusted for that, 80 divided by the market cap, 21% of its price could be justified by the asset value, and it's trading at $880 a share. So roughly $185 a share of that price can be attributed to fair value of assets. So it's not really an $800 stock, it's a $600 stock. Forward earnings, roughly about $20. It's really trading at about, that's not even adjusting for any future growth, really, or adjusting it by a growth rate, 30 times forward earnings. It's not unrealistic for a company like Costco. You got a membership price raise coming in, which is roughly about 8.33% of its price, of the membership price. Membership revenue goes right to the bottom line. There's no cost. It just goes right to the bottom line. So you can get a huge increase, 8.33% increase in cash flows in perpetuity. Well, at least for the next 5 years. Their plan is to raise it every 5 years. So what's that worth in terms of the multiple? And their data. They haven't even begun to monetize their data. Costco knows what kind of membership I have. It knows what stores I go into. It knows what I buy. It knows roughly what my frequency is, what my average cart size is. It knows that I only buy certain things when they're on sale, and I'll buy 6 at a time or 7 at a time, and I'll only buy. It knows all this stuff about me. It hasn't even begun to monetize that. It hasn't begun to say, okay, well, let's send him an email 2 days before we normally know he goes. So let's see if we can get him in here today. Let's see if we can increase his frequency from 17 times a year to 19 times a year. Because once you're in a Costco and you're walking along, you see something and you say, oh, I didn't even know I needed that, right? I mean, how many times have you gone to Costco and walked out going, I didn't intend to spend that much money, but I didn't know I needed this until I saw it. It hasn't even begun to explore its data. How much is that worth? How much is its data worth? So when you start adjusting for certain things, you might realize that something which appears overvalued really isn't. I remember looking at Apple in 2010, 2011. Once you adjusted for cash, it was trading at 11 to 12 times forward earnings. And I was thinking, this is a steal. Why wouldn't everyone just load up on Apple? Just adjusting for the cash it's sitting on, you have an extremely low multiple. It can't possibly be a value stock. Um, and Apple did very well. It was $90 at the time, $85, $90 at the time. So if you think about the S&P 500 companies, you have a price on the index of 5,600, forward earnings of, call it 250. Well, what if of that 5,600, what if $500 is cash? What if you went through and checked all the cash and you weighted it all like the S&P and you find out, well, hang on, there's $500 in cash. Well, that's two multiples. So it's not really 22 times forward earnings at that point. It's really 20 times forward earnings for the franchise. And then what if you went through and you looked at the asset accounts that for all the companies that aren't listing their real estate at fair value, and you readjust their real estate? What makes Costco so interesting in terms of the value of its real estate is it doesn't spend a lot when it originally sets up a location, because it is a destination. It doesn't have to be in a high traffic area. It is a destination. You will go to Costco. But have a look at where Costco's originally set up. If you have one that's set up 10 years ago, look at what's built up around it. What's happened to the value of the land as things build up around those Costco's? The value of that land is significantly higher than what it lists it at, because it lists land at what it acquired it at, and it doesn't depreciate land, but it doesn't increase the value of the land. What if you did that to the S&P 500? I'm just hypothesizing. 22 times forward earnings in the market, with interest rates where they are, with global tensions where they are, with economic data where it is, and the market doesn't seem even slightly concerned about that. You have to think, am I missing something altogether? Am I still remembering when I went to the corner store with 5 cents and I got a bag of candy, like your grandfather used to tell you? Am I too old? Have I missed something, or is it just something simple like that? Like, well, you haven't accounted for all of these other things that if you took it out, maybe the value of the S&P 500 isn't that ridiculous. I don't know. That's why I asked in the video, does anyone know of anybody who's done that? Does anyone know of any work where they have done that? What do you think of Canadian banks at the moment? Listen, Canadian banks are like Tim Hortons and Canadian Tire. They will always exist in Canada, and they'll never go out of business, and they're an institution. There are 5 big banks. Well, there are 6 big banks, 5 serious ones, and CIBC. I think they basically it's an oligopoly. Where are you going to go? Canadian regulators don't want anybody else coming in, so they'll always do well. I think they have an incredible history of never ever canceling their dividend. You're talking like some of them 150, 200 years of never canceling it, because some of these go back to the 1800s, never canceling their dividend, increasing their dividend over time. So if you buy bank stock today, 20 years from now, based on what you paid today, the dividend yield you're getting 20 years from now is going to be significant compared to what you paid, because they continue to raise their dividend. We don't have to worry about a dividend cut, because they have a history of never cutting their dividend. Even during the Great Depression, they never cut their dividend. It is a staple in almost every portfolio in Canada, right? So I think they're worth going into. They do have options. They do have good dividend yields. The options can help you double the dividend yield quite easily over time. And if you reinvest all of that, I think you do quite well on that. Do you think they're going to face a lot of mortgage default risk? Not really. The stress, they have to hold the mortgages for the most part on their own balance sheet. And there's a stress test, which means when you go get your mortgage, they stress your ability to pay at 100 basis points higher than where the mortgage rate is. Being that rates have been coming down at this point in time, I think you'll get the same amount of defaults that you'd normally get. I don't see a major spike in defaults at this point. Like, yeah, you're going to have people with trouble. That always happens, but not a significant spike. Especially given the fact that you were stress test on the way in. Applied level subscriber, where do you post your videos for options trading? In applied options. Hang on. Oh, bit of a sneeze there. What do you think about currency rates of the whole world? Oh, of the whole world. You have to be more specific than that. Why some currencies worth more? Currency worth more than others. How do you figure that? How do you figure that a currency is worth more? Is there a true economics or is it a fraud system? Well, it's not a fraud system. How are you figuring that they're worth more? Just looking at the price, saying, well, the euro's 110, it's worth more than the US dollar. You can't say that. You can't say that it's worth more. You have to look at, what does 100 euros buy and what does 100 US dollars buy? If they buy the same things, they have parity. That's called purchasing power parity. That's how you would value a currency. That's its long-term attractor point. A mid to long-term attractor point or equilibrium point is relative purchasing power parity. But you can't just look at the price of two currencies and say, well, this one is, the euro is 110 for 1 US dollar. You get more euros. You get 1.1 euros you get 1.1 US dollars for every euro. Hence, the euro is worth more. It doesn't work that way. It's, well, what does the euro buy versus what does the US buy? So I think you may not be understanding how currencies work, especially if you're asking the question at the end, is it a fraud system? No. Recently sat for CFA exam in August. Wanted to upgrade my package to include applied level. Didn't know about the permanent access to applied level if bought pre-August. I don't know what that means, permanent. There is no expiration for the applied level. You can buy at any time. There's no expiration, and you get whatever I add to the applied level. Now there are some modules that I'm adding that you won't get. Those are only for those who bought before July 31st. They're grandfathered in on all content, because I will have content that is going to be added in that will be produced by other people. There has to be some revenue stream for that. It's almost impossible to figure out what that is if everybody just pays once. So you'll pay once for the applied level. You'll get everything that I do, but not the add-on modules. For the financial modeling, you'll get that. That was always going to be a part of the applied level. Okay. How to make the first 100,000 from the market? I don't know. What are your thoughts on Jay Powell's legacy? Was he too late to hike? Did he overshoot going to 5.5? Is he too late to cut in September? These are questions that will be asked for quite some time. I don't know that the answers will be harmful to him. Everyone is very forgiving if you land the plane. Everyone forgets about the turbulence on the flight if you land the plane, and everybody goes off and enjoys themselves. They forget about all that stuff. But you can have a perfect flight and crash a plane, and there's your legacy, right? So it will be dependent upon the economy. Bernanke had handled the financial crisis very, very well. And one of the reasons I think that he wanted out was because there was no more upside. He could only make a mistake at that point, and his legacy was intact, and he was going to be remembered as the person who saved it, who saved the system. Why would you mess with that? Get out while the getting's good, and it doesn't pay that much to begin with, 180 a year for the head of the Fed. I don't think the market will remember him poorly. You said you were planning to move to Panama. Why didn't you move there in the first? Didn't like Panama when I was there. Didn't like it. What did change since you chose Costa Rica as your final residence? You got to stay in Costa Rica 6 months plus a day. I don't know if I want to do that. Having been there, the only time that I'd want to stay there is in the summertime, which in Costa Rica, summertime is November, December, January, February, March. I don't want to be there in the rainy season. It rains every day, and mosquitoes are off the chart. I haven't been bit since I've been back. I get bit 3, 4, 5 times a day down there, and that's me going out of my way to avoid the mosquitoes. But you got jungle all around you. You're gonna get bit. In the summer, driving is yeah. Let's just say you don't want to. Let's just, after Christmas is over, once you get into January, it's okay. But driving anywhere in December is just stupid. It's just stupid. I can't even take stupid and square it. Panama doesn't have the same residency requirements, so I could be anywhere. I don't have to be there. I could be anywhere. That sounds a lot better to me. What are the tactics or strategy you use when you're in a losing position? Well, number one is, why am I losing? Am I losing because of something bigger than the stock that I'm in? So Freeport, GM, these were all losing positions when I had originally sold puts. But there was a good reason why. Everything was losing. So if I believe in it, and it is, everybody's losing, and I don't think that it's a trend. I think it's an event that the market is having some difficulty now, but it'll be over in a couple of weeks, and then I will lean into that. I will say, great, I can now buy at a cheaper price. If I'm in something that had a idiosyncratic event like Lamb Weston, that was a good example. Sold 72.50 puts for $1.50, and after earnings, Lamb Weston was at 55. Average price was 71. What do? Well, you have to assess, if you were not in this stock at 55, would you be in it at 55? And my answer was yes, I would. If I wasn't in it right now, I would be in at 55, which means I stay in. But if I would not be in at 55, then get out. There's no point in trying to salvage that position. Just get out. If I have no options to work with, then all I can do is wait. And if the stock pays no dividend and I have no options to work with, then get out. What's the point? It depends. It depends on why am I in the losing position? Why is that position losing? Struggle with idea generation when it comes to trading. Well, that's the hardest part, right? Is there any any advice you can offer or share? How do you generate ideas? Be curious. Just be curious. Find what I think is a good strategy is take a sector, any of the sector ETFs, take the largest company in the sector ETF and just start reading its 10K. You just start reading, and you'll learn something, and you'll determine whether or not there's something here. Every stock fits in one of 3 buckets: a buy, a sell, or a hold. Holds are great, I think, because you can sell puts on a hold. A hold is a stock that is probably not going up, but it's probably not going down. Great to sell puts on, great to sell calls on. You can do short straddles on that. A buy is great because, well, now I've found something that potentially is going up, so I can either buy stock or I can sell puts, higher delta puts, and a sell if I need to add some negative delta to hedge out maybe long delta, or I'm just too long. Stocks that are a sell are great to sell calls on because you generate negative delta. So every stock fits into one of three buckets. Every stock, and that's how I would generate ideas. Early 30s, 60K. Well, congratulations. That's a lot for early 30s. Would you implement the same strategies you use now? No, I would not. If not, what would you do different? Well, let me qualify what I just said. If I were in my early 30s, there's a high probability I wouldn't understand the strategies that I use now because it's a lifetime of experience to understand the strategies and have the intuition of when to use them. In my early 30s, I would not have the experience necessary to know when to get out. So I could follow somebody on the way in, but if they disappear, how do I know when it's time to leave? How do I know what my next move is? Right? So if I were in my early 30s and I had 60,000, I would follow probably one rule that I should have followed years ago. Do not trade anything you don't understand. If somebody says this company's really good, it's going up, and you buy 100 shares, ask yourself, what are their margins? What's the trend in their margins? What's the trend in their sales? What do they sell? Do they have anything that is unique to them? What's their cash flow look like? Is it positive cash flow, negative cash flow? What's the level of their debt? Do they have history of issuing shares? Is the share-based compensation to management representing 15, 20% of the shares outstanding every year? If you can't answer any of those questions, you don't understand what it is you're trading, in which case you shouldn't be in that stock because you're not going to understand. If you don't understand the drivers of its performance, you're not going to understand when those drivers disappear, right? Would you take more risk than now? Well, take more risk than now. Probably. I'd probably take more risk than now, yeah. But sometimes you take more risk because you don't quite understand what the risk is. So you end up with positions that are risky, but you don't see them as risky because you don't understand where the risk is. What are your sector bets during the new rate cutting phase? Well, in rate cutting phases, utilities always do well. So utilities would be there. I think energy and probably not traditional forms of energy, but maybe alternative forms of energy would be interesting to look at. I think it really comes down to who wins the election on that one. But I mean, it's worth lining up some names now, I think. Materials, I think, something to look at. Why are you short small cap if they are much cheaper than large? Well, being cheaper doesn't mean anything, right? Just because something is cheap doesn't mean that you should buy it. It might be cheap for a reason. The Russell 2000, I think, has the highest level of unprofitable companies it's ever had. You have the highest proportion of companies where the debt servicing cost is greater than the cash flow from operations, and we're not getting 200 basis points of cuts in the next couple of months, in the next few quarters. We're not getting that. So I think it's just too soon for small caps. Also, I think in the Russell 2000, you've got a significant enough group of those stocks that were large cap stocks. So they're on the way out. All right. I just, I'm not, when I'm short small cap, it's not the S&P 600, it's the Russell 2000. I think it's just, it was an early celebration again. I don't think they're ready yet. All right. Where did we leave off here? You said duration is one of your big conviction trades because of the rate cuts. Yep. You also said that you don't know how many rate cuts are priced into the 20-year yield. No, you don't really know how many are in the 20-year yield. Well, I wouldn't even use the 20. Use the 10 or the 30. The 20 is an odd tenor. I wouldn't even use the 20. Use the 10 or the 30. You don't know how many are priced in because the short end of the curve can drop 100 basis points and the 10-year might only drop 30. So how many are in now? I don't know. How do you know then that your expectations aren't already priced in TLT? Well, you can sort of just judge from the reaction that it's had. You can look at where yields are. You can look at how yields have moved. Everything is anchored, not to some absolute value from 30 years ago, but it's anchored to something in the most recent past. And I think it was just too much too soon. It's nothing. I mean, I didn't break out the slide rule in the calculator and draw lines on charts and do a bunch of calculations to get there. It's just me looking at the market going, this doesn't feel permanent. I don't think it's ready yet. This is the game we play, right? Experience can help us. Intuition can help us. But in the end, we do have to make some bets based on what we think. If I didn't sell calls and TLT retraced to 97 or 96, I'd be pissed off. If I did sell calls and they kept going up and up, well, okay, some of it gets called away from me. I have a very large duration position anyway, so I wouldn't be too concerned. I don't think they'll be called away from me by October. I don't think the Fed's going to lead off with 50 basis points. I think they're going to lead off with 25. So I think that it has gotten a little ahead of itself here. So dollar delta beta is your preferred risk metric. How is it calculated? Take the dollar value of your position, multiply it by the beta of your position, multiply it by the delta. So if you have stock, the delta is just one delta for every share. If you have options, well, you might have a delta of 0.3. So it's the dollar value multiplied by the beta multiplied by the delta. And it would be the dollar value of whatever the option buys. So if it's 100 shares, it's the dollar value of the shares times the beta times the delta, because the delta is only 0.3. Because you are getting the price behavior of, well, if you have 0.3, the price behavior of 30 shares of stock, right? Mortgage rates Canada are variable rates tied to prime rate. Fixed rate tied. Well, fixed rates are tied to the 5-year bond because they're 5-year fixed. Variable, I don't know what it's tied to. What would it take in today's interest rate environment for the variable interest rate to be lower than the fixed? Upward sloping yield curve? Like a steeper upward sloping yield curve? Which metric of IV do you prefer? IV rank or IV percentile? Well, every week I report the IVP, IV percentile. I prefer that a lot better than IV rank. Where do you think U.S. yen heading throughout this year? No, not a clue. Not a clue. Bank of America research analysts say it might go to 112. They're guessing at 155. It's an educated guess, but that's just a guess by the end of the year because the yen still doesn't pay. So that's just a guess. I have no idea. They have no idea either. What they're basically saying is we think it weakens. Not as much as where it used to be, but more than where it is now. What's halfway there? 155. Yeah, 155 sounds good. Um, Very rarely are these things right. If you have 100 people, one or two may be right, only because statistics say that out of that distribution, somebody's bound to be very, very close. But I have no idea where it's going. That's not the point. The point is, if it weakens, what do you think is going to happen, and where do you want to be? If it strengthens, what do you think is going to happen, and where do you want to be? Right. So that if you want to be, if it strengthens and it weakens, and you find something that is common to both, you may as well be there because it'll work out regardless of which way the end will go. But currencies are brutally difficult to forecast. I wouldn't even say they're unforecastable. So they're going through the exercise of forecasting it, I think, is a colossal waste of time, as opposed to just developing scenarios of, well, what if it does this? What would I do? What if it did this? What would I do? Now, what if it does this? What do I think is going to happen in the market? This could go up or this could go down. Okay, well, then now I'm on the second part of the tree. If this goes up, what will I do? If this goes down, what will I do? I don't know. I don't know where it's going. I'm not interested in making a bet on where it's going either. I think it's stronger right now. So if it strengthens, the peso will weaken, which just makes Mexico more attractive as it's weakening. So the yen is 62 basis points stronger, 0.43% stronger. The yen is 0.72% weaker. That's been a fairly decent relationship since the yen started strengthening. Is the peso started weakening. So something like EWW, the ETF for Mexico, selling 51 puts, 52, 51 puts on that one. See, that's what I would look for, is what would I do if it went this, if this went here, what would I do if that went there, as opposed to trying to figure out where do I think it's going. I don't know where it's going. I have no idea where it's going. Nobody has any idea where it's going. Those are all guesses. If you thought about starting a Discord channel for the Applied Series members, would be cool to have a place to communicate with your viewers, who I assume are generally more educated. Series. I do answer questions in the comment section on the Applied level. I only get like 2 or 3 a day, which is good. I'm not asking for 500 a day. Don't bury me, because I will stop answering them at some point. But I do answer them there. I don't know how active I'd be on a Discord channel, only because my day fills up. It really does just fill up. Thoughts on PSN being undervalued? I know nothing about that one, so I have no thoughts on that one. Have you seen any of the L3 feedback for this past cycle? Any thoughts on the potential increase in dividend? I haven't heard anything about it at all. No. How do you judge REITs? Best factors for that, you would in the applied level, in sector studies for real estate, I go through I think 5 different REITs, understanding residential REITs, office retail, industrial, and timber REITs. So I do discuss that at length there, but that's not a simple question. How do you judge REITs? That's, that's a seminar. That's not a question. What do you think about Brazilian market? Know nothing about it. I am a U.S. market expert. I barely know anything about the Canadian market, really. Where's the TSX? I haven't got a clue. I know very little about the Canadian market, and I've lived here all the way up to what last fall. I mean, my whole life I was here, and never once did it occur to me that this was a market that I wanted to invest in. It just didn't make sense. The U.S. is the biggest, most liquid market in the world. Hoping for a live session for the CFA stuff soon. Been a while. Work at an asset management company. Cannot trade options and single name stocks. Only have limited options to choose from, mostly ETFs. Any suggestions how to maximize my returns with only ETFs? Well, there's an ETF for almost anything, for almost any factor exposure that you want to get exposure to. Beta, there's your SPY, beta and tech, triple Q. You've got sector ETFs for every single sector. XLE for energy, XLU for utilities, XLP for staples, XLY for discretionary. There are specialty ETFs that track home builders, home construction, that track different markets, India, Mexico, that track different types of. There's ETFs for everything. So it's a matter of, well, what do you think is going to happen? And just pick out the ETF. I saw some of your older videos and you look trimmed down now. Keep going from 202 to 130, 202 to 132. What are you, 5'4"? 202 to 132. Yeah, that would change your life. That's 70 pounds. How did you walk around with 200 with an extra 70 pounds on you? My dead weight is 187. Dead weight is 0% body fat. My dead weight's 187. I'm this morning on the scale, I was 226.6, which is, for me, it's almost an 8-year low. I couldn't break 228 for the longest time, and now I have. But later this afternoon, when I got on just before my shower, I was 225, which seems about right for me. But I couldn't lose weight for the longest time, no matter what I did. Increase my cardio, like I just couldn't lose weight. Now I'm on it's closest to an Atkins diet with a narrow window of eating. I don't eat till 3-4 in the afternoon, and usually by 9:30, sometimes 10, depending on how hungry I am, I stop. So it's 5-6 hour windows. That's it. I'm trying to move it to like 2:30 and end at 8:30. I'm trying to get into that window, but it's just been intermittent fasting and low glycemic food. So you look up all the food that you eat and you see where it is on the glycemic index, and anything that was high glycemic, you just stop that altogether. Anything that's medium on the glycemic index, you try to see if there's a low GI substitute, and that's what I've been doing, and it's been working. I don't crave carbs anymore. That was the biggest thing. In those first couple of days, you can't even focus. You're so hungry. 11 o'clock, 12 o'clock, 1 o'clock. I can't make it. After about 4 or 5 days, the cravings of carbs, they go away, and I can now sail into 3 in the afternoon fairly easy. Maybe with about 3 coffees to get to that point, because coffee, it cuts your appetite. I feel better. I sleep well. Lately, I haven't been sleeping well. I don't know why. I've been doing the financial modeling module, building it, because you got to do the whole Costco and CapREIT thing, and sometimes you're trying to figure out how to get something done elegantly, and that's difficult. And I go to sleep, and all freaking night long I dream about it, and it's like, God, I can't get this out of my head. I keep modeling this cost in my head, and I can't sleep when I I'm working on a problem all day long. Um, it's easy to make a complicated model. I mean, that's easy to do. You can make your model as complex and complicated. I shouldn't say complex. That's a different word. You can make it as complicated as you want. That's easy to do. Making it simple is brutally hard. Having everything in there, but making it so simple, crash proof, so that nobody can crash it and that you can update it really easily. Um, that requires a lot of thinking in getting that level of elegance. And I tell you, I'm nowhere near where the professionals are on this, but I am getting there. But thank you. I am lighter. I know that. Clothes are fitting me better. I can sit in a chair longer. I used to, down this side of my back, like this side here, right at the very base. I used to get this sciatic nerve and I'd have to keep, leaning this way. Or I used to have pillows here, and I used to just kneel on the pillows because I couldn't sit. Now I can sit in a chair for a period of time. I can sleep on my back for a long period of time. I never used to be able to, and I can sleep on both sides now. That's new for me as well, at least in the last 8 years. What hurt me a lot was the dog. The amount of walking I had to do each day. Uh, I knew that when it was over, I wasn't going to escape without some kind of permanent damage. And it got so bad for a while, I had to sleep on the floor, like on a hard surface, because I needed full support all the way through. I couldn't have my body curved down in any way at all. And I was doing CFA stuff at the time, so you're sedentary all day long. Other than when you're walking the dog, you're just sitting there working. So I was gaining weight over that period of time, and it was the pain. I mean, I went through some serious pain. It's getting better now, but yeah, I'm down. My highest weight, believe it or not, was 249. I couldn't believe 249. I'm down to 225, I believe, the scale this afternoon. So 24 pounds off my top weight. I can't get much below 210. I can get to, I mean, the best fitness of my life of 208, 207, and I can't hold it for long. You're starting to get under 10% or pushing down to 10%, getting under 10% body fat, and I couldn't hold it for long. Anyways, enough about that. Do you take any supplements, vitamins, eat specific foods, whole foods? No, I don't do any vitamins or anything like that. I'll tell you what's in my diet. It's a lot of greens, romaine lettuce, cucumbers, tomatoes. What else goes in there? Broccoli, because I make these salads and I just throw everything in there. And I just use olive oil. Pork chops, like lean pork. Steak, not so much. Steak bloats me. Every time I eat beef, I feel bloated for like a day or two. Chicken, I've been cutting back on chicken because it's starting to give me kind of a reaction. I get itchy in here and here when I eat chicken. So I sort of cut that out. Brown rice, I don't know what the rice I have is called, but it's not soft rice. It's like when you're eating it, it's a little bit hard and it's like chewy. I don't know what kind of rice it is, but it's a whole grain brown rice. Um, it's not a fun diet. I'll tell you that. I eat for survival at this point. There's very little I eat for enjoyment, other than cottage cheese. It's mostly just survival. But I got to lose weight because I want to live to 100, and there are no 250-pound 90-year-olds because you don't make it to 90 at that weight. And the longer you wait, the harder it gets to lose the weight. So you got to do it now. You have to train your body to be a fat burning body forever, regardless of what you do. And it takes time to get that done. But no, I don't take any supplements or vitamins. I get enough of it out of the food I eat. Oh, lots of fruit too. Oranges, cantaloupe. What else is in there? Not too many apples, but apples. Um, yeah, that's about it. Would you be able to turn down the volume? It's a bit loud. you you don't have a volume on your channel? I mean, at home on your computer, you don't have a volume? That'd be like me calling up Fox and saying, "Can you guys turn it down a bit? It's really loud on the TV here." Um, this is the first time somebody says it's too loud. I think you're poking me on that one. Poking the bear because for the longest time everyone kept saying it's not loud enough. Now it's too now it's too loud. Um, I'm looking at the meter at the bottom, and it's got like 6 little dots, and I'm really only on the first 1 or 2 dots. So I believe you have a volume control on your end. Just turn it down a bit, or maybe I could just whisper for a while and see how that works out. What do I think of the new Starbucks CEO Brian Nickel working from home? Hope he's got a fridge full of Brookside chocolates. I don't get the Brookside chocolate reference, but not investment advice. But what stock do you like? I think it's been very clear over the last couple of months what's on my conviction list. CapREIT is number one. FCX, NextEra Energy, XLU, GM, especially when GM drops in price. Love GM. I think they're so massively undervalued compared to other car makers. Even if they had went from, what are they at, 4.8 times forward earnings, if they went to 8, where people want to, or the market wants to place Ford at 8, and it's not a great company. If GM went to 8, it'd be an $80 stock, not a $48 stock. It'd be an $80 stock. And they've got a burgeoning robo-taxi business in there. Yes, it has had trouble, but they all do. I think those troubles are behind them, and they'll be joining the Uber platform. I think they'll do quite well. Why are they getting no kudos for that? They're getting nothing for that. The halo effect of Corvette, I think, should do a hell of a lot. That's doing nothing. 4.8 times. It's a head scratcher. It's like, why would it be so cheap? And why wouldn't Tesla just take out GM at $80 a share, right? And what do you get? You get Cadillac, you get Corvette, you get huge cash flow, 3 times the cash flow you're already generating. You get huge earnings per share. You get a robo-taxi business, which you don't have. I don't care what you say. You haven't got a robo-taxi business. And you're not going to get it on a national scale the way you think. Boggles the mind. There it is, sitting right there. But I like that one. Do you have any suggestions for European, North American office REITs with office REITs? Exposure, CBD, prime CBD that could be worth it. I'd say the biggest one in that space, I think, is Boston Properties. What are they, over $70 now? They were down around 55 at their lowest. I did sell puts on Boston Properties for a while, but office is a tough one to play. I wouldn't play anything but office REITs. If I was going to be an office REITs, it's got to be in gateway cities, primary cities, and top properties in top cities. LA, Chicago, New York, Atlanta, Miami, like big cities. Suggestions on how would you do that? You recommend studying ethics for CFA 2 weeks before the exam, but does that mean you should do the mocks after you've studied ethics, which will only leave you 2 weeks for review? My recommendation Look at that. It doesn't even break the glass when you drop it. My recommendation with ethics, at least for me, is it's not intuitive. It's nothing I'm going to really know on a fundamental level like math or arithmetic or accounting rules. Those you can really know. Ethics is a memorization game for me, and memorization, you're putting things in short-term memory. Short-term memory has a very fast decay rate. So my thinking is if I'm going to use short-term memory and not internalize it to long-term memory, if I'm going to use short-term memory and I know it's got a fast decay rate, I want to put stuff in there as close to the exam as possible. So that's sort of what I'm getting at when I say, that you want to do ethics last as close to the exam as possible. Do you think quants will overtake stock picking business? No. Overvalue investors, especially found in the case of Renaissance Technologies and Citadel. Uh, if if you're looking for percentages, if you think of this as a football game and you're playing for inches to get to the next down, maybe quant has an advantage there for you. But you know, the way that I look for things, I'm looking for things that the market just isn't picking up on. AT&T was a good example at 1650, cap rate at 43, GM under 40, only after the buybacks. Freeport in the mid 30s for a while. I mean, these were all things that XLU under 70. These were things to me that I didn't need quantitative analysis to get done. It was a good story, and the market just wasn't respecting these companies and respecting their valuation. Would quant have picked those up? Would quant have picked up cap rate? Would quant have even been looking for anything, or would it have just looked at it in relation to all the other REITs and said, well, they're all valued in around the same in terms of multiple of FFO or AFFO? Would quant have picked them up? Maybe quant would have picked up a deviation between this REIT and that REIT in terms of the multiple and said, oh, there's something here between these two. But would it have said that given the environment that we're going into, and given the population dynamics in the Canadian market, these things are extremely undervalued at 20% discount from NAV? Would quant have picked that up? The way you can tell is were they invested in any Canadian REITs? If the answer is no, then quant didn't pick that up. Cap rate went from mid 43s to 52 over a period of 2 months, 8 weeks, raised their dividend at the same time. And you had 2 dividends during that period of time. That on its own, the raw return on that is about 20% over that period of time. If you were using the options judiciously, you did a hell of a lot better, 30, 35, maybe even 40%. I've done very, very well on cap rate. And the big gains, I think, are gone. The big move is gone because you have a stock that can rise like this over time, right? So if you buy it at this point in time, it can rise based on some expected return. And if you buy it fairly valued, you'll get whatever expected return you think you're going to get out of these. But if you're buying it way down here, it's first got to get to fair value before it then gets its expected return over that period of time. That gap between where fair value was and where it was trading has been significantly closed, with a net asset value based on fair value of investment properties of $56 a share, sitting at 52. It's getting closer to being fairly valued. That doesn't mean it's time to go. It just means it's time to lighten up because that big part has been made. Would quant have picked that up? I don't know. All right. I look for good stories. I don't know if quant looks for good stories. So no, I don't think quants will overtake stock picking business. What is your top strategy for growing a small account? Stay small. For growing a small account, don't look at dollar values, look at percentage return, right? So there's nothing wrong with buying one share of an $800 stock because a 5% return on an $800 stock is the same as a 5% return on a $10 stock. Don't start thinking that, well, it's easier for a $10 stock to go up 50 cents. That's still 5%. $10 stock adding 5% to its market cap, or an $800 stock adding 5% to its market cap. Don't think in terms of dollar value. Think in terms of percents, and think in terms of how much money you want to invest, not how much 100 shares cost, right? You got a small account. You say, well, I'll put $2,000 into Costco. Well, that's 3 shares. That'd be $2,400. Nothing wrong with buying 3 shares. Costco goes up 10%, and you bought $2,000 worth. You go to 2,200. Well, it's the same as buying 100 shares of a $20 stock and having it go to 22. It's okay to think that way. You have $20,000. You say, okay, no more than $2,000 in any one position means I can have 10 different positions. I'm going to cut my losses as soon as I'm down 15% on any one stock. So if one stock goes bad on you, you lose 300 out of 20,000. That's nothing, right? So you don't have to keep. I certainly would not. I would not be all in and all out. I would not say I'm going, well, I don't have a lot of money, so GM, I can only buy 400 shares, so I'm going to buy 400 shares. What you're saying is you're 100% invested in one single name. Not a good idea. Not a good idea. Have discipline. Size your position so that you're not too focused on any one particular stock, and have a contribution plan. I got 20,000. Well, how are you going to get it to 21? Let your positions grow, but how are you going to grow your assets under management? Which means you got to have some kind of contribution plan. You're not going to make this your income on a $20,000 investment. You're not going to earn an income off 20 grand. Get that out of your head. You're not going to double it every 3 months. You're not going to earn 100 grand a year off a $20,000 investment. Not going to happen. In trying to do it, you'll lose the full 20. Have a contribution plan, right? And over time, it will build. What are the options to create your own pension plan? Thoughts on buying annuities versus setting aside a low-risk portfolio and managing on your own? I don't know that I would buy an annuity unless you plan to outlive your assets. An annuity is sold to you by an insurance company. An insurance company is a for-profit company, which means they're going to make a profit on that. And an annuity is something that you could do yourself. You can create your own annuity. The only thing the insurance company has on you with the annuity is longevity risk. If you live a lot longer than the statistics say you should, then you're good with the annuity. But other than that, you can create your own annuity without paying the insurance company's profit. Depends on how old you are as well. If you're already thinking about creating your own pension plan, whatever country you're in usually has a pension plan already. Canada has CPP, the US has Social Security. You contribute to that. There's a maximum amount you can contribute each year. So if you have a job and you're well below the maximum, you can opt to contribute more up to your maximum. You can do that. You can opt to contribute more. You have RSPs as well. There, I would seem to think that utility stocks and bank stocks, depending on the country you're in. Canada, I think you can't go wrong with utility and bank stocks in your RSP. And if you want to be really safe, you can load up on their preferred shares. They have great preferred shares, which has a nice dividend. Lots of things to look at. If you don't know any of this stuff, I strongly recommend that you get that you sit down and talk to a professional on this one. Do you do any can you do analysis on the silver market? Why? I've done one on copper. I've done one on gold. It's the same thing except it's silver. Get a company's 10K, and everything I say about copper and everything I say about gold applies to silver, right? You're going to look at their resources and the reserves. What is the reserve price? What's the level of the resources? What's the level of the reserves? And every mining company will tell you what its forecast is for production in terms of how many ounces of silver they plan to produce. In the end, all miners are price takers. So determining whether or not you want to be long any miner is determining whether or not you would be long the basic commodity, right? But if you go through understanding copper miners and you go through understanding gold miners, say it's the same thing, except every time you hear me say the word gold, just pretend I said the word silver. Every time I say the word copper, just pretend I said the word silver. It's the same thing. Once you understand one miner, you kind of understand them all. I've completed CFA content and my exam is November. I am weak on FSA and derivatives. How would you recommend I allocate my time for review? And should I start doing mocks earlier? Well, it's only August. Your exam's November. I wouldn't do mock exams at this point in time. You've already said that you have a couple of weak areas. There is where I would spend a little bit more time and see if I can't crack it. See, okay, there may be some kind of mental block I'm having with derivatives. Can I get through it? Can I break this one? I don't know that I would start mock exams this far out. If your exam is November 14th, I think early October 14th is probably a good time to start mock exams. What's the manufacturer dividend strategy called in the applied series? I don't know that it's called anything other than what I just called it, manufacturing a dividend. You're just selling calls or selling puts. Very low delta, 10 deltas. You could do short strangles on it with 10 deltas. Your goal is not to earn the most premium you can. Your goal is to replicate the dividend so that you get a double dividend. Maybe you want a triple dividend. I don't know, depending on what the premiums look like. I don't know that I actually called it anything. I would look at the short strangle because in there, it's in there that I would probably say you can use this to replicate a dividend. Any interest in mortgage derivatives? Inverse IO on the right coupon might be an interesting curve. Steeper inverse IO on the right coupon. I don't know what you mean inverse IO. Interest only, like IO to me is interest only. I don't know what that means. How would you suggest I should start reviewing fixed income for level 1? It's too vague of a question. My exam window is on February 25th. Should I watch review videos or just start solving questions? Well, with fixed income, you're going to have if there are quantitative based questions, fixed income is certainly a place that they would show up. There's fewer quantitative questions on exams today than there were 10 years ago. So I don't know that I would do a hell of a lot in terms of quantitative based questions. But it will help you conceptually understand what's going on, because you may just get a question saying, here's the situation, here's the price of something, this has changed, what's going to happen to the price? And you'd have to say, well, okay, that's in the numerator, that's in the, you'd have to conceptually see where the price would be, higher, lower, the same, based on some setup that they would give you. Um, yeah, I don't know that I would in any section. I don't know that I would abandon the conceptual for the quantitative, even though the section primarily seems to be quantitative driven, like quant, like derivatives, like fixed income. I think I would have a good, firm understanding of the conceptual reason why this condition says the price should go up or the value should go up or down. And if you get that, then, you know, I guess if you do work with the numbers themselves, it'll help with the conceptual side. Just don't get so into the numbers that you say, okay, plug and play, plug and play, plug and play, because this plug and play, you might conceptually lose. Well, like if you change one variable, what would happen? Well, you'd want to start plugging and playing all the numbers to see what the change is. Can you intuitively see what it would be? Would you answer a career-related question? If I can. Took level 3, waiting for results. 31, have no experience in financial area. Previously worked as an academic researcher in microbiome. I think it's plausible to find an entry-level role after passing level 3 as an analyst in fixed income or equity. Yeah, that's why I said if I can answer it. I am so far removed from the job market. My age removes me from the market. I don't hire this. I mean, I don't have a business that hires that particular skill set, and I never had a real job in my life, to be honest with you. So I never had to go get a job. So I don't know today what employers look for. I don't know what they look for, to be honest with you. I still think it's a who you know thing, not so much what you know, but who you know. So the social capital you have is just as important as the human capital you have. Is it plausible to find an entry level role? Sure. Other than that, I know very little about the job market. I'm long NVIDIA. Upcoming earnings, how would you protect your position in terms of protective put? Well, you just said it. In terms of the expiration date of the put, no matter what you do, you're going to pay for it, right? The nearest dated puts will be expensive because you'll have increased volatility in there, so they're going to be expensive. So you can buy a longer dated put. It'll cost you more money, but it probably will have much lower implied volatility and a larger time value component. So it may decay slower if NVIDIA goes up. That's yes, I wouldn't be in that stock in front of earnings because it is going to move. It is going to move one way or the other. And if you don't have a conviction about which way it's going to go, this is a gamble for you. You're going to pay for it. Yeah. And when do you buy your put, right? Let's say NVIDIA's 130 and you buy a 130 put on Monday, and NVIDIA goes to 150 before earnings and then crashes to 130 after earnings. Well, you've just lost the whole value of your put altogether. You should have bought the put at 150. So you got to wait and you got to buy the put as close to the earnings announcement as you can. But everybody will be doing that. The implied volatility will push the value of that up to the point where it'd be almost impossible to make money on that. And the very next day, NVIDIA could fall, but because you paid so much for the put, you get what's called volatility crushes. The premiums could just crush completely, which doesn't protect you from the downside, and you lose money on the put. It's a tough game to play in front of earnings because everyone's going to play that game in front of earnings, right? So 3 months out, 4 months out, buy a put. But if you're wrong and it really goes up, Delta will take a lot of value away from you. So there's There's no cheap way to insure yourself 3 days ahead of a tornado, right? When playing Vega trades like events or earnings, should you look to wait until after the IV crush and buy a straddle, or try and sell the IV? Well, everything depends on what you think is going to happen. So you have to look at the straddle, and you have to look at what the implied move is. So let's say it's a $100 stock and you're getting $7 for the straddle, buying the call and buying the put. That implies a 7% move, either down 7% or up 7%. So you have to say, is it going to move more than 7% or less than 7%? If it's going to move more, then buy. If it's going to move less, then sell. It all comes down to, you tell me what you think is going to happen, and then I can tell you what a strategy would be. But for me to tell you a strategy and to tell you what's going to happen, I don't know. You tell me what's going to happen, right? And even if you wait till after the IV crush, well, what do you think is going to happen then? Do you think the stock will just continue to go sideways? Okay, then go ahead and sell the straddle. But if it's going to move after earnings, then you sell the straddle. You might want to buy the straddle after. Again, you tell me what you think is going to happen first. That's how that works. Went through all your videos on options, CFA level 3 Canada, FRM level 2. Follow you weekly for 6 months, wondering how far it can take me with a 100K current portfolio. Multi-millionaire. What time frame? What time frame? If you said, I'm going to start going to the gym, I'm going to put on 40 pounds of muscle bulk, can I do that? Sure. And you say, great, next Friday I'll be, whoa, next Friday. Hang on. No, not next Friday. What's your time frame? Yeah, you'll get there. What's your time frame? If you are targeting 20%, which is what I do, you should be able to double it every 5 years. So 100 goes to 200. 200 goes to 4, 4 goes to 8, 8 goes to 1.6 million. That's 4 times. So 20 years. The road is long, right? If you're looking for bigger returns than that, you're probably going to blow up because you'll be taking on way more risk than you should. Yeah, you got 100K, you're going to follow a good strategy, and you're going to continually contribute. Never stop contributing. You always contribute because you need to increase your assets under management, which are your own assets. But sure, you can get there given enough time. But if you tell me you want to get there in 2 years, I'm not your guy. There's some people on TikTok that can tell you that you can get it done with Bitcoin and leverage. Maybe it works out for you. Maybe it doesn't work out for you. As long as you're comfortable losing 100K, right? What charting platform do you use? I don't really chart a lot. I'm having a bit of trouble finding some of the data series you use in your videos. I use TradingView mostly. If you use Koifin has a publicly facing side that is free to a certain extent. You can do some of those charts. Besides dollar depreciation, do you see any fundamental behind the OxyFX trade? Well, copper. I've been very clear on what I think about copper and Oxy. Yeah, lots of free cash flow. I've been more than clear on that over a long period of time of what I see there. Recently, EIA, OPEC lowered their oil demand forecast while China economy is still struggling. Yeah, it's possible. Yeah. But I don't know that has anything to do with FCX. As far as Oxy is concerned, it's the free cash flow that's attractive. So with a free cash flow yield, they'll only trade down to a certain price. I think mid 50s is probably a place where they'll bounce off of a few times. And if you are looking to buy value, you can't wait until all the lights on the street are green before you go, because if they're all green, everybody's going to go, and it's already too late. You have to be willing to buy when the news isn't that good. You have to be willing to buy when there's a belief that this is not where you want to be. If we go back to the fall of 2023, I was saying housing, the home builders is where you want to be. And I got questioned on that. But why? When rates are going up and they're going higher, why would you want to be in home builders? And they ended up performing better than tech stocks over 6 months, up 80, 90, 100%. Because you're going into them precisely when nobody else wants them. Now, you can't just do that just to do that. There has to be a fundamental reason why you think everybody's wrong and not wanting them. So Oxy, I think, has good exposure to the Permian, which is a nice high-yielding basin that lends itself well to enhanced oil recovery. So their cost, I think, per barrel is, well, with enhanced oil recovery, is much lower than it would be if you were drilling, which just adds to their cash flow. Trying to find questions that I don't have to keep saying I've never heard of these things. Aren't the equity and bond markets saying very different things? Equity markets expect margin expansion late in the business cycle. Bond market expects dramatic slowdown. I don't think the bond market's expecting a dramatic slowdown. Well, maybe. I mean, you can make the case that they are saying different things. You can make the case that the bond market is concerned about growth, while the equity market is not concerned about it at all. It seems you can make that case. I don't think I'd push back on that too much. But I don't know that I would go so far on the bond market and say they're pricing in you're saying a dramatic slowdown. I think they're pricing in an increased probability that there's a slowdown. I don't know if I would use the word dramatic. I think that's probably where I would just differ. Advice on navigating corporate politics. Despite making positive contributions, I'm struggling to gain recognition from my boss. Others acknowledge my efforts, but defer to my boss, leaving me stuck in the same position. While changing jobs is an option, relocating isn't feasible due to personal reasons. Yeah, I'm not a politically correct person. I don't think I would work well in an organization because I don't know that I would give a shit about the politics at all. It would be, about a job that needs to get done, and that would be it. I don't know that I would really consider too much, and maybe that's probably why I wouldn't work out in an organization, is because I wouldn't be political. There's one book that I read a while back, like a long time ago, called The 48 Laws of Power. And one of the chapters was about making your superiors look good, right? And in making them look good, they, as opposed to outshining them, you're making them look good. They would, in turn, not see you as a threat and remember you for that. I don't quite remember what the lesson out of it was. Is that politics or is that a personality issue? I don't know. But yeah, the workplace is it's not my thing. Thoughts on Nouriel Rubini's paper when he talks about Janet Yellen has been manipulating the yield curve by over issuing T bills, decreasing the issuance of notes and bonds. Rubini says it has equated to a 100 basis point cut in Fed funds rate by depressing longer term yields. So that's imagine that you were a corporate treasurer and you're issuing debt, and you have a choice between fixed rate and floating rate. That's the bond versus bill question, right? Is you're managing this big portfolio of debt, you have to issue new debt. You can lock in 4.5% for the next 30 years, or 4.6% for the next 30 years, or 20 years. Or you can say, well, the short end of the curve is at 5.5. It's expensive today, but it rolls over every 30 days. And if I think that rates are going to be coming down, wouldn't I rather have a floating rate, be short a floating rate than a fixed rate? So you would tend to move to the short end of the curve and issue more on the shorter end. And as rates start dropping and the long end starts coming down, then you'd start issuing more on the longer end. Why lock in 4.5 for 30 years when you can pay 5.5 for a couple of quarters, maybe 5.25, then maybe 5, then maybe 4. It would be cheaper in the long run to pay more of shorter term interest and a higher floating rate of that, and then lock in the longer term rate on the way down. It could be that it's something like that. I mean, if that were explained to you, you'd say, okay, well, I guess that makes sense. It would result in more issuance of T-bills than bonds, which means you're going to have some effect on the yield curve. I don't know that I would call it manipulation as much as an unintended consequence of managing duration now, right? With the 10K reviews, you could have the 10K. Oh, I think 10,000 reviews. Where am I getting the 10,000? 10K. You could have an intro with the materials to be covered, so we can do it ourselves first, and then compare with the highlights notes you made. Sure, yeah. Who would you say influenced your investment philosophy the most? Howard Marks. Any company that you can suggest planning to analyze, which can provide 2 to 3x return in the next couple of. Is that all? 2 to 3 times return? That's all I'm looking for. Would it be a bad strategy to invest some percentage of your profit into a little risky bet? Well, no, but you're looking for something that'll provide 2 to 3 times return in the next couple of years. So is everybody. Let me know if you find something. That's what everybody's looking for. It's not as if you've stumbled across a strategy, say, well, look, this is all I want. So does everybody, right? Good luck. I don't know that I could suggest something saying this will be 2 to 3 times in the next 2 to 3 years. I have no clue. Maybe it could be. I don't know. Beats the hell out of me. I don't know that I would look for that. I want a 10 bagger. I want a 5 bagger. I want one of these. I don't want to buy this. Is it going to go up 3 times in the next? I would look for something that has a good story, and the market will deliver what the market will deliver. I don't know if it'll be 2 to 3 times. Who the hell knows? But to say I'm not going to invest in anything unless I want 2 to 3 times. How do you know? How do you know? Nobody knows. You need a good story, right? And the patience to wait it out and to make sure that you're right. But I don't know what's going up 2 to 3 times in the next 2 or 3 years. Not a friggin' clue. Not even a close clue. Nope. An opinion on the rate cut, fertilizer stock. I haven't been in fertilizer stock since, geez, potash way back in 2009, 2010. I left that market behind. I haven't been in that for a long time. I don't think it's going to be interest rate related. I mean, it's ag. I don't think that's going to be interest rate related at all. Let's just cut rates so we can safely embark on the next asset bubble. Yeah, if we're not already in one now again. CFA level 1 through program at work. Oh, the guild ED. Okay. I have an old account with level 1 plus applied. With a program about to start, use the same login. Both MM account and work email. I don't believe the applied level is through your program at work. You might have the CFA program, but I don't think the applied level is there. But on our site, you should still have access to the applied level. I don't think that you have it through this other program. Mining operations being energy intensive, they are a relatively large carbon footprint. Yeah. How do you factor in raising ESG considerations? Who cares? ESG, who cares? Who cares? Who cares? Who cares? Who cares? That stuff is dead. That stuff is dead. Where to invest 15K in RSP? I don't know. I know nothing about you. I don't know your age. I don't know your risk tolerance level. I don't know what stocks you're holding in your taxable account. I don't know what your exposure is to real estate. I mean, I know nothing about you. Anybody who tells you, oh, go ahead and put it in this or put it in that, doesn't know what they're talking about. How could they possibly know what to tell you without knowing a damn thing about you? I know nothing about you other than this comment. I can't even come up with any kind of remote answer to that at all. No clue. Don't understand how the SOM was such a big deal a couple of weeks ago, but now we've got a revised job report, which is even worse, and the market doesn't react to it at all. I really don't get it. Well, it's the news cycle that can drive the narrative, right? Here's the interesting thing about the SOM rule, about any rule. If you didn't know it, would you know to react to it? Right? I mean, if you didn't know it, if you didn't know that this rule existed and that it got triggered, would you know to do anything about it? So sometimes the existence of one of these rules can create the behavior that the rule predicts would happen, only because you believe that that's what would happen. Hence, you act before the behavior actually happens, thereby creating the very behavior and saying, see, told you, right? Something that's widely believed can have effect. And everyone's talked about it, and it's done its tour of the talk shows, and the creator was on Bloomberg a few times, was on CNBC, did her tour of the talk shows, and now we've moved on, and there'll be some other narrative that drives it for a while. But this is what happens when the media gets a hold of something interesting with a catchy little name. Is it's everywhere, and then it's nowhere. Then you got to move on to something new. So this is a situation of the media that's just drives the narrative for a period of time. And again, if you didn't know that there was something like this, if it was never created No one would know to react to it. No one would know, right? Can you say that the Fed controls the short end of the yield curve? Yes. Treasury having big control over the longer end, bigger, with buybacks and QRA and Yellen have already made 50. With buybacks and QRA, the Treasury didn't do buybacks at the long end, I don't think. Already made 50, 100 cuts on long. I wouldn't look to the Treasury to have caused that. No. Do you look at secular trends such as what do you mean when you say a secular trend? Thematic investing. Well, I mean, yeah, if you listen to any of the stories I tell about Canadian apartment REITs, that was a theme. Copper, that is a theme. Utilities, that is a theme, right? So yeah. Why would you adjust valuations for property values if, as a going concern, you'd only get the earnings? Well, let's say that you sell drugs out of your Lamborghini, and your drug making business does about $100 a week. And let's say I'm going to say, okay, well, I'll tell you what, I'll give you 3 times sales for the next year. I'll give you $15,000 for your business. Can I have the keys to your Lamborghini, please? And you'd say, well, hold on. I said, well, I mean, you're doing business out of your car. This is your office. That is an asset. Should I not get it if I buy your business? So suddenly your business is worth the value of the Lamborghini plus the cash flow that you're generating, right? So you're not gonna give me your Lamborghini for $15,000. You may sell me your drug dealing business for $15,000 because it's only generating five grand a year for you. You might want to take 3 times sales. That doesn't mean you're going to sell me your office, right? Besides, it brings up the question of how the hell are you affording a Lamborghini on $5,000 a year? But that is why you would adjust the value of a company, because it may be sitting on an asset that may have been depreciated to zero, but is $100 million asset. Right? So you should adjust for it. What's your take on Canadian real estate? Well, that's a big question. Canadian real estate, where? Looking to diversify my portfolio into private real estate. Private real estate where? What kind of real estate? Are we talking about residential? Are we talking about apartment buildings? Are we talking about storage facilities, medical properties, healthcare REITs? What kind of real estate? All right. Is it timber real estate? Is it farmland? Wow, that's a big question. What do I think about it? You tell me what specifically you're talking about when you say real estate. I can tell you what I'm thinking about, but it's such a big thing. I don't want to say, oh, I really like it. And you think, well, he likes office properties in secondary cities. He said so. Whoa. I never said that, right? So what kind of real estate? Do you understand salt true beta? Never heard of it before. I don't know what that is. How could one break into a markets related role from Big Four audit? Any question about the job market? I'm basically going to say, look, I don't know anything about it. I am so far removed from the job market. Will the silver gold ratio widen or tighten? I don't know. I see no reason why it would tighten. Why would it? It has diverged from its long-term multiple of 50. So silver times 50 equals gold. It hasn't been that for a very long time. It's been 80. Where are we now? Over 80. I don't know. Being that it has not mean reverted back to its 50, I see no reason why it would mean revert back. And if we don't have mean reversion, is it going to widen or tighten? Beats the hell out of me. I don't know. Maybe, but maybe not. I think that's a good answer. Nobody knows. I mean, all of these things about forecasts of something like this. I know it sounds odd. How can you possibly be doing this if you can't forecast? Some things are unforecastable. You have to recognize when it's worth forecasting something and when it's not. Something like this beats the hell out of me. I have no idea. If I had to go based on supply and demand and where gold is in terms of its yield per ton, in terms of the number of Class A sites that are available left in the world, which probably none other than what exists, is there'll be less and less gold mined going forward unless the price goes up significantly, but you don't have that problem with silver. So if I had to make a bet one way or another over a long period of time, I'd probably say in 5 years, the spread wouldn't surprise me if it were wider, right? Wouldn't surprise me. B. Riley's 30-day option implied volatility is over 200. I don't know this B. Riley fellow, which means the company may face. Oh, B. Riley's a company. Okay, near-term issue. However, the baby bond Riley MDU. I have no idea what you're talking about. Do you see any chance to profit from this? I think you have my answer. When doing options for dual-listed Canadian U.S. stocks like Enbridge or Canadian banks, do you buy options on the U.S. market, or you buy them in Montreal, the Montreal Exchange? I don't. You'll find in the U.S. market liquidity is almost non-existent on these. The liquidities in the Canadian market. Got an interview for ETF mutual funds inside sales. Coming days. Any tips? Well, it's sales. It's sales, right? So it's going to be on your personality more than anything. You got to have some knowledge, but sales role is personality. Be personable. Just from the basics of equity valuation using discounted cash flows, it's safe to assume rate cuts would lead to increase in equity and bond market prices. Well, bond market, sure. Rate cuts, all we can say about rate cuts, I don't even know if you can really say this about rate cuts. I was going to say that it could lead to a lower cost of capital and lower the denominator, but it may not. Some companies, it may not affect their cost of capital at all. So I don't know that we can say that across the board about equities. Rate cuts will increase the numerator for companies that have floating rate debt because it will decrease the interest expense and increase the numerator, but their cost of capital may be based on a certain required return on equity that is not going to be that sensitive to a 25 or 50 basis point rate cut. And it may be more sensitive to the riskiness of their own cash flows. Or it may be based on a company whose equity risk is already fairly low, has a certain amount of debt, but has derivatives that cap their debt at a certain rate, which means any rate cut isn't going to really affect their cost of capital. So I don't know that we can say definitively that cost of capital will go down. I don't know that we can definitively say that. I think that we can say the marginal cost may decrease, but not the current. If the capital structure is fixed, I don't know that I would be adjusting weighted average cost of capital for rate cuts. I'd look to see if there's any effect on the numerator for rate cuts. That would seem to be the obvious thing for me. Low capital investors, would you recommend investing in small caps? This is mostly in, well, no, I think I've answered that one before. Don't worry about the size of the money that you have and trying to find stocks that fit your account. It's okay to buy Costco at $880 a share. If you say, well, I only want to spend, I got 10,000, I'll buy 5 different stocks. I don't want any more than 2,000 each stock. Just buy $2,000 worth of Costco. Maybe that's 2 shares. Maybe you only buy $1,760 worth of Costco. If it has 10% upside, you get 10%. I think that you probably have a better opportunity for larger brand name companies to gain 10% than some small cap at a low price that used to be $50 and now is $10. Those rarely come back up. When they go from 50 to 10, rarely do you get back up there. But something that's gone from 50 to 100 quite often can get to 150. Or I shouldn't say quite often. There's a higher probability that something that has gone from 50 to 100 can add 20% than something that's gone from 50 to 10. A higher probability. So look for good quality companies that add to their earnings. Thoughts on Palantir? Haven't really gotten into it. I did a small assessment of it, I think a couple of months back. It was losing money at the time. I don't know if it's still losing money. If it's making money, it's certainly not a lot per share. But other than that, I don't follow it. It's not on my list of stocks that I'd be interested in. One index is superior to another that have similar objectives. How do you go about rating index construction methodologies? I don't care. I don't care. Really. I guess I'd have to ask you, why do you care? Unless that's your thing, unless you're creating some kind of investable product from an index, you might care about index construction, or if you're using one as a benchmark, you might care about that. But overall, what do you care? I don't care. Don't care. Not because it's not important, just because it's not important to me, right? The same reason I don't care about the mating rituals of snails. Yeah, it's probably an important thing because snails are critically important to the ecosystem, but I don't care. I don't care. Index construction, I don't care at all. Can you manufacture a 2 to 3x dividend on ABR and agency? Ooh, ABR and agency have high dividend yields, right? So let's just have a look at agency, and we'll look at its where are we? REIT agency 10. Let's have a look at the options. This thing pays. Where's its option? Where's its dividend here? $12.44, 12 cents a month. Let's look at the options out for September. No, hang on, September 20th. No, there's not enough premium in the options. You'd have to get aggressive to match the dividend. You're selling a $10 put. It's at 10.24. So here you could you'd have to go out by quarters. Let's have a look at November. Yeah, even that. You could double the dividend, but you'd have to get aggressive. You're looking at the $10 put. It's 10.24. The $11 call, even going out to November, has almost no premium in it at all because its dividend is so high. Everything will be in the puts. So something like agency would be hard only because its dividend yield is already so very high. That doesn't mean that you can't get something I mean, if you were willing to accept more shares, then yeah, I'd go, if I had, let's say 500 shares and I wanted another 500, I'd go out to November, the $10 puts, you probably get 40 cents for the $10 puts. If they're not put to you, you've triple, that's three dividends basically, plus you're going to get three dividends over that period of time. You've doubled the dividend if it stays above 10.24. With rate cuts coming, I'd have a hard time seeing on its own why it would drop below 10 with rate cuts coming. But that's going to be hard. The higher the dividend is, the harder it is to do, right? So that's going to be a tough one on agency. If you lighten up on XLU, to expect it to trace back down for a better day to buy it? No, like if you don't lighten up, what happens is when you buy a position at a certain value and it starts going up, the value of your position becomes bigger. All you're doing when you're lightening up is you're resizing back to the position size that you wanted to begin with in terms of dollar amount. So if you want 100,000 at risk and you buy something that goes up 20%, you've now got 120,000 at risk. Lighten up, take 20,000 off the table, get back to 100,000. So if you don't risk manage, if you don't do that, you risk giving it all back, right? If you take the 20,000 off the table and it retraces and now your 100,000 is back down to 80, put your 20 back in. Buy, if not, and it keeps going up, at some point it'll be worth 120 again. Take another 20 off, resize back to 100. This is how you play the game. So as the stock is going up, you should be holding fewer and fewer shares of it to maintain a constant market value over time. That's why I'm reducing my position on CapREIT because at $42 times 64,000, it was a certain price, but at $52, it's a much higher price. Well, let's take some of that off the table, right? And let's resize the position so I'm back to a certain dollar amount that if it did pull back, it's like, well, this is CapREIT's money. This was the money I earned from it, so I can take it and I can buy more shares now because I was willing to bet 100,000, let's say. I still have 100,000, but this thing has dropped down. I still only had the 100,000 at risk. All this money that I got was free money off of this one stock. Now I put myself back to 100,000. I own even more shares than when I originally had at 100,000. And if it keeps going up, just rebalance back to the original size you want. Nothing wrong with lightening up on the way up. But I don't lighten up because I expect it to trace back down. I lighten up because, what was 350,000 is 375,000. Positions up 75,000 based on the synthetic I created. Why not take 75 off and get back to 300? If it pulls back, take the 75 that I got for free, basically, and I can have an even larger position on it. If it doesn't, well, I'm risking the same money I had to begin with. I found SPY cash and short-term investments to be 1.44 billion. Can this be extrapolated to get the index level cash? Well, what would be the market cap of SPY altogether? 565 billion. Oh, I think you're wrong. I'm going to tell you right now, you're wrong. You think that all the SPY components are only holding $1.44 billion out of a total market cap of 565 billion. I can name you one company right now that has that in petty cash, 1.4 billion. I mean, Apple has more than that alone. So I think you'd have to rethink that. I think that's got to be a lot higher than that, a lot higher than 1.44 billion. I mean, GM is one company, and I think GM's sitting on 30 billion. Tesla's sitting on 28 billion. There's 58 billion right there, and that's only two companies. I haven't even gone through the other 498. Right? So, do you mean 144 billion? 1.44 with a B. That's wrong. Any small cap tech company you are watching? No. What's your take on nihilism? What's a philosophy that I don't know that nihilism is going to get you anywhere. Where's that going to get you? And I guess you'd have to ask, like, why? Why would you even buy into it? I mean, how useful is it? I don't know that it's useful at all. No, I don't. I can see as from a interesting philosophical perspective, if you wanted to have debates about something in a purely theoretical space, okay. But as far as being pragmatic, where's that going to get you? As you were long AT&T around 1650, why not continue on the long until it's near 20? It is near 20. 1950, 1960, it is near 20. I made a lot on AT&T by selling the puts. I made more selling the puts for the amount of capital required to sell the puts than I would have had I used just that amount of capital and bought the shares. I made a lot more on the puts, a lot more on the puts. It was a no-brainer. AT&T was a no-brainer. Shall we start selling? Looks like markets are pretty overvalued. Nah, I'll pass on that one. What's your opinion on how a reverse stock split impact your forward-looking opinion on the share price of the company? Wouldn't affect my opinion about it at all. If a stock that was selling for $1 did a 10-for-1 reverse split, it would be $10, but have only 10% of the shares outstanding. It wouldn't change its market cap, and it wouldn't. Its valuations would. It's not like it would have better valuations. It would have the same valuation. It just has a different price, but it would have the same value. I don't have an opinion. I don't think a reverse stock split would do very much. Housing starts in Canada are just starting to decline too. Canada's almost no. Didn't our idiot prime minister announce something today? Or your idiot prime minister? He's not my idiot prime minister anymore, but I think he just announced something today about housing. Feds identify 56 government properties for conversion to affordable housing. And since the government is doing it, it is going to cost a shitload of money to get affordable housing because the government's doing it. They don't do anything cheap. Would the abundance of liquidity in the market slow down the path for rate cuts? I don't think so. Thoughts on TLT puts for September ahead of FOMC? At these levels, I don't think I'd be selling a put. Do you mean buying a put? I'd rather sell a call than buy a put. How do you create your own annuity? Well, what is an annuity other than a series of coupon payments from bonds, or how is the insurance company going to do it? Primarily treasuries, right? So you can create your own. If it's payout over a period of time, usually it's some combination of treasuries plus a long dated call on the market. You can do that yourself. to go through the technicals of how to get it done, to walk you step by step how to get it done. I don't think I'm going to do that here, but you can create your own. How do you think about the trade-off between mortgage pay down versus investing excessive savings? Currently a 5% fixed mortgage. Find it challenging to invest in this market given high multiples. Well, yeah, that is the trade-off. Is that every dollar you put on your mortgage saves you 5 cents a year for as many years as your mortgage would last. Because we'll assume that you're paying off the last dollar first. If rates were, I think if mortgage rates were lower, like around 3%, I think it wouldn't make a hell of a lot of sense to pay down a mortgage versus investing. I'm going to pass on the questions that ask me to do things for people. Okay, I'm going to scroll to the bottom and move up. We're at 2:20. I'm going to cut it short tonight, maybe in the next 20 minutes or so. There can be a story to buy into, but when do you realize the valuation is too high without trying to accurately model the price? Experience, following the story, following the company. That's all it is. For some companies, it's rather easy to determine. For others, it's a little harder. So Freeport, that'll be a hard one to determine when it's time to get out, because that depends on where you see copper prices going. But something like GM, if GM traded up to 8-9 times forward earnings, that would be put it this way. I don't have a target. It's more about how did we get to that price that I then start thinking, is this justified? How did we get there? If we got there from $48 to $80 on GM by earnings just growing 20-30% a year, then I'd say 80 is not done. But if earnings grew at a 5-year historical growth rate and the stock went to a multiple of 8 times, I would, at that point, I'd say, yeah, I think, it's priced where traditional car companies would be. Maybe it can trade to 9 or 10, but it's not as compelling as when it was at 4. You know what I mean? Cap rate at 55 is not as compelling as it was at 43. At 43, when its book value per share was 56, is far more interesting than when cap rate's at 52 and its book value per share is 56. It's like, well, it's not as compelling anymore. Doesn't mean that the story's over. It's just, it's time to lighten up. It's not as compelling. So some things I can only answer by saying, experience in time will give you some intuition. It's not always some mathematical formula you run. If everything worked that way, if there was no need for experience or intuition, if you could boil everything down to an algorithm, finance would be taught in computer science. It wouldn't be taught in a business school. It would be taught in computer science, and none of us would be here. It would be a bunch of coders and programmers talking about their new algorithm, because finance would work on rules. It would all be rules based. But it doesn't break down to that. So there is a big aspect of experience and intuition involved. Sometimes, when you're in your mid-20s, you lack that. So sometimes you're not going to see, it's not going to make a lot of sense to you, and you want it to make sense. It's like, but why? Why did you decide to go in here and get out there? What was it that you were looking at? Because you want some of that experience and knowledge. And sometimes it's nothing that I can say in words. It's just sort of, like your parents say to you when you're in your 20s, wait till you have children, you'll understand, because they can tell you all day long what it's like to worry, but you're not going to know until you have children of your own. Then you're going to go, oh, I get it now that you have the experience and you're in that position. Some things it's just experience. Yeah. What advice would you give to 21-year-olds starting to learn about valuation, wanting to invest about 2,000 of his savings into his first shares commodity ETF? Buy the market, buy an ETF, buy the market, buy a portfolio of stocks. Don't just put it into one, and then have a plan of how you're going to increase your $2,000 to 2,500. And then when you get there, have a plan of how you're going to get it to 2,800. And then have a plan of how you're going to get to 3,500. And you just keep going that way, understanding the road is long. And as long as you're on the road, step in front of step in front of step, you'll get there. It's when you try to run faster than what you can run, you're going to mess up badly. Either diversification or concentration. Half and half. This broad diversification, not really. I don't think you need 100 different stocks. I rarely have more than, I think if I have 15 names at any time, that's a lot. Average number. Individual names, under 10 most of the time. And then it's a lot of macro stuff like ETFs, like XLU, like EWW, like TLT, like US Treasuries, or either long ES or short ES. It's a lot of bigger plays like that, or something in currencies. But individual names, not, 30, 40 would be unmanageable. I think, how could I possibly follow 30 or 40? You got 30, you're talking about 120 earnings a year, 120 earnings reports, 120 earnings calls, conference calls that you got to be on. That's unmanageable. If you have a life, I still have a business that I build. I have, property in 2 different countries. I can't possibly follow 30 stocks seriously, right? You simply can't. So no, I probably more concentrated than diversified. Investors like Buffett and Druckenmiller seem to like to bet big in stocks they have conviction. So do I. I mean, if I have something that's in on my conviction list, if it's 1, 2, or 3, I'll break my rule. I'll go above 2%. Yeah, I will do that. Would you prefer a back of the envelope discount cash flow to forward PE ratio for quick valuation check? I've never done a discounted cash flow on any company stock. I've never gone as far as to do the valuation. Once I understand the drivers of revenue and the drivers of cost, and I look at the company and I think, is there a good story here? Good enough. All I care about is the direction. This thing is valued too low, and I can look at its valuation based on some industry multiple or some common multiple that's used. But discounted cash flow, I don't think I've ever gone through discounting cash flows. When we do CapREIT and Costco in the financial modeling videos I'll be adding this fall, you will gain an appreciation for just the sheer amount of assumptions that you need that are all your best guesses of what revenues and costs and cash flows are going to be and what assets the balance sheet's going to look like. It's just a mountain of assumptions. And then you're going to discount those cash flows and come up with a price that you think, well, here's the price. That price is built on a mountain of assumptions. There's never a price. You'll do sensitivity analysis, which means, okay, well, this one assumption, let me change it and let me see what range the price ranges over. Now let me change this variable and let me see what range. So you'll come up with a range of prices, not just a point estimate, but a range of prices. It's a huge amount of work to do for a retail investor. It's a huge amount of work, which personally, I think, based on the amount of dollars that you're committing to each trade, is a colossal waste of time. Have a good story. Understand what drives that revenue. Understand what drives the cost and what management strategy is. And ask yourself, given the price that I'm paying, is this too little? Is it just about right, or is it too much? And I look for, this is too little. When I see this is too little and I've gone through it, I'll add the position. But discounted cash flow on the retail side, I don't know that it is a valid use of your time, because your cash flow forecasts are big wild, or I shouldn't say wild guesses, but when as a retail investor, I'm assuming you're not a sophisticated financial analyst. So most of your assumptions will be wild guesses until you become an expert in that particular industry. And then you're going to tell me you're going to guess at something as complex as the company's weighted average cost of capital to discount those cash flows and come up with a price that this is the price. No, it's your best. It is a combination of all your best guesses. Now, every best guess has some variance. And your next best guess has some variance, and the next one has some variance, and the next one has some variance. And the further out you go, the wider those variances are. So when you have 30 different assumptions, your variance is already fairly wide, and that variance increases year in, year out. Going out 3 years, I would say that you're more than likely going to be off by 10, maybe even 15% on your assessment of what free cash flow is going to be. So how precise can your discounted cash flow be? I personally find it, again, for the retail investor, not the institutional, but the retail investor, a colossal waste of time. Unless you've been doing this, following a company for 5 years, 10 years, you really, really know it. You've modeled everything right down to the level of inflation per cost category that they have. Like, you've developed a model that you've got thousands of hours in, and your variances over the years have been very, very tight, and you're updating it quarterly, and your model updates everything, and every time you update, you get tighter and tighter. And after 5-6 years, then maybe you're somewhere in the neighborhood of a nice tight range of prices that stock could trade within. But you're selling that research to thousands of possible investors. If it's just you, it is a colossal waste of time. As we go through the financial modeling, just for Costco, just to model out its membership revenue, the assumptions you have to make in getting to that membership revenue. What is the retention rate? What is the actual number of members they have? You think, well, it's $60 a membership times the number of members they report. The number of members they report is a trailing number from 6 months to 18 months ago. It's not today. And they sell memberships for different prices in different countries. So you can't use. So, well, how are we going to do this now? That after we, get through the income statement, you may say, this is a lot of work to do, isn't it? I mean, I get what they're doing, and I'm sold. I like what they're doing, and it seems to be fairly valued to me. You will find that as you go through it, the power of going through it is uncovering all your assumptions and understanding what drives every line item. the actual modeling and getting to a forecast and bringing it back and discounting it, getting it, that's, I think, got the least amount of valuable information for a retail trader. I don't do all that work. I mean, when I look at a company, after I list out what drives revenues and what drives expenses, I don't need to forecast out 5 years. I don't really need to do that. I just think, okay, I'm in. I like this based on where the price is. I like this. This is a good story. And then I'll take an initial position, and then I'll see how it plays, and I'll go from there. All right. What do you do when the market doesn't agree with you, but deep down you know that this is the value? Why isn't it move? Well, I buy more. I get angry. So the cap rate is a good example. It was sitting at 43, went to 46, came back to 43. I was like, well, I'll just buy another 10,000 shares if this is what you're going to do. And you can, if you're here, you can hear me. Sometimes I pace around. I think I'm not wrong. I don't understand. Why is it doing this? And I just buy more. So, yeah, I've been in quite a few positions where the market just says, we're not on board. We're not on board. And okay, at this price, I'll just keep buying more because I know at some point the fundamentals are going to show up and you'll have no choice but to go along for the ride. I'm not wrong. And their earnings were good, and they raised their dividend, and with rate cuts, the fair value of their properties are going to increase. So 2020, 21, I think even 19, 20, 21, they had fair value adjustments on the downside. Now they're going to have fair value adjustments on the upside. I'm not wrong. I stick with it. I stick with it. What's your target CAGR per annum? 20%. You benchmark your performance against an index. It wouldn't make any sense for me to have an index because I invest outside the index. Any index you give me, I invest outside the index all the time. The moment you add a currency, the moment you mix equity with fixed income, and then add some futures and short positions and options, you've gone way beyond the index. So to benchmark yourself against an index is not really fair. It would be like, let's say I was a runner, and you say, "Did you beat your benchmark?" I said, "Yeah, I'm a lot faster than that 5-year-old kid across the street." Well, that's not a fair benchmark. Well, you didn't ask that. You just said, "Did you beat your benchmark?" It's that kid over there. You would then say, well, that's not a fair benchmark. It should be somebody that's in around your age, that is in around your weight category and in around your experience. If you're just beginning running, maybe you're benchmarking against somebody else who has just done that as well, but certainly not against Olympians. So you would look at how I invest, and I'd say, sure, I beat my benchmark. My benchmark is a 3-month T-bill. You'd say, well, that's not a fair investment based on what you're doing. Or sorry, that's not a fair benchmark based on what you're doing. So I don't really have a benchmark because I leave myself free to do anything I want. So it's easier to have a target return. 20%, I think, is easy enough to do. My Lira, my RSP are all fairly consistent at about 20.5%. My TFSA about 20.5%. Now I can't use options in those. So it's a combination of either I'm in cash or I'm in a high conviction play. Once that drops in conviction, it's cash. High conviction play. I don't feel that I need to be 100% invested all the time. But 20%, I think, is a fair target. Discounted cash flow versus ratio question. How do you get the feel of the valuation, and if you are underpaying or overpaying for the stock? You can use simple multiples of cash flow, multiple of earnings, depending on how the industry is normally valued. Just use some common multiples, and go from there. Forward earnings tends to be a fairly good one to use for more mature companies that don't really need a lot of growth capex anymore. Free cash flow tends to be a better multiple to use. Certain industries or sectors you avoid completely. Healthcare for the most part. Industries, anything in biotech, I don't understand it at all. I mean, you could say, here's a company with this product that cures this thing. Here's the details about it, and be like, if you say so. I mean, I don't know. I have no medical training, no biological training at all. I wouldn't recognize, especially if you're like phase 2, phase 3 trials. I wouldn't recognize a home run hit if you put it right in front of my face. So I have no skill set there at all. Why would I even bother on that one? And you can do a deep dive and you can learn, but with biotech, you're not learning the industry. You're learning the science. That's a different thing altogether, and something I have no desire to spend the next 5 years doing. And you could spend that long really getting to know just even a couple of companies and what they're doing, and how can you assess its potential, or I mean, like, I have no skill set there at all. So I would never be a biotech investor, for the simple reason that, how do you even begin unless you have medical training and training in that specific thing? I don't even know what you'd call it, that thing, that drug, or that body function. How would you even know? Just listening to what other people say. I mean, no. So yeah, there are some things I avoid altogether. Best advice for someone beginning level 1: have a plan and discipline. Have a plan and work the plan. That's the goal, right? The goal is not to get this section done in 3 weeks and that section done in 3 weeks. The goal is to have a process that you go through, and you're not racing through the content. Give yourself a lot of time, have a process, and work the process. Then every day is a victory. Doesn't matter if you only cover 4 pages, as long as you stuck with your process, that's a victory. Adopt process as your goal, and give yourself lots of time. And don't fall victim to the, I got lots of time, I'll do it tomorrow. If it's easy not to do it, then your heart is not there. It's something that you're really not interested in, right? If you have to, I gotta study, I'll do it tomorrow. If it's easy to put it off, it's not for you. Or you have to find some joy in it somewhere. You have to find something that draws you to it. All right, I think we're near the end here. Would you stay away from biotech even from an ETF level then? Yes, I would, because I don't understand it. I don't understand it. So even from an index level, how do I know that the ETF is got a whole bunch of overvalued stocks in it? How do I know when to sell calls, when to sell puts? I mean, it's all you're doing is saying, I don't understand these, so let me put them in a big group. I still don't understand the macro. Even if you combine the micro to the macro, I still wouldn't understand it. Yeah, I would still avoid it. Any update on GME positions? I didn't lose on those, but I didn't hold them all the way to expiration. GME is it's a gambling stock. I mean, if you to say that you've made money on it, I've made money on it twice. I have no desire to really play it. I don't know what they're going to do with their money. That's the point. I don't know what they're going to do with their money, and there's no good story to it. So, were you born a brunette or a blonde? Brown hair, I guess. Not blonde. Yeah, brown hair, light brown. All right, I'll grab a couple more and we'll be done here. Oh, already answered those. Would you consider offering paid coaching sessions? No, I don't want to do that. It's not scalable. It takes a lot of time. And yeah, no, it's just nothing that I would want to do. What do you think about day trading? I think it's like a hammer. It's useful when you have a nail. Day trading it's not a strategy. It's a tool. I have day traded. I don't set out to day trade, but sometimes I take a position and something happens over the course of the day where I may change my mind and say, I don't want that position. And it may be in profit, a little bit in profit. And I think, no, I've changed my mind. I'll take it off. Well, that's a day trade, but I didn't really mean to day trade. Other times I'll do something and it really moves where I didn't think it was going to move at all. I thought, well, this is a 2-3 week position and it moves. It does everything in one day. Okay, well, then I'll take it. So I have done day trades before, but I don't set out at the beginning of the day to say, let's day trade. If it works out, it works out. But my intention is not to day trade. I don't think that you can do it effectively over any long period of time, and make a return that compensates you for the risk that you're taking. Okay, I think we're pretty much done. Do you still believe in the value of the CFA? I do. As critical as I am of the direction that they've gone in the last few years, I still think there is no better aggregation of training for financial markets at a general level, okay, not a specific level, at a general level than CFA. The CFA is a generalist designation, meaning it doesn't make you an expert in any one thing. It gives you general knowledge about a whole bunch of things. I think it's still the best collection of information for that. I think the new writers that they have a lot to be desired. They could do a lot better. I think abandoning the academic writers and the Wiley writers that they originally had. Wiley, when I say Wiley writers, these are writers that had published textbooks for Wiley. Wiley in finance is the biggest publisher in academic finance. By abandoning that and saying, well, we don't want to pay those fees, we'll just create our own stable of writers, you're losing a deep bench of editing. So many mistakes are introduced into the reading, and not only mistakes, so much silence is introduced into the reading where something is said, but it's not said completely. It's like, well, yes, you started off, but you didn't finish it. So this is not entirely true now, is it? I think that is a problem. Is the growing amount? Like I never used to. 10 years ago, you'd read. It was beautiful stuff. Very rarely would you say, whoa, that's wrong. Oh, you had little errors in the end of chapter questions here and there, or the examples had adding errors, but never fundamentally wrong shit where you say that's not even true at all. No, it's not like it's a typo. It's just, this is not even true. But now you have that. Like, this is not even true. And it's completely wrong. It's just completely wrong. It's not even true. And then you do have a woke element that has been creeping in to the curriculum that has presented itself at level 3 in a rather stupid way that you're going to lecture level 3 candidates who are going into wealth management about the evils of wealth, and go on for pages and pages lecturing them about how evil wealth is. The fuck? I mean, what kind of decisions are you making? So I've been critical of some of the directions that they've been going in. But I think with new management, not new management, let's call it new leadership, which I think they need is some new leadership. I think with some new leadership, they can get back to their core of being the benchmark in finance, as opposed to the bandwagon, which they seem to be wanting to just hop on that bandwagon, going by that ESG certificate I thought was stupid, and ESG is leaving. How many companies are now abandoning their DEI efforts? I think now's the last time that you'd want to jump on the woke bandwagon. It's gone. That's gone. We all recognize how simple-minded that whole ideology was, and to still be jumping on that bandwagon. But as far as the core, the level 1 core, level 2, the valuation process for fixed income, for derivatives, for equities, I still don't think that you're going to get a better concentration of content. I think they'll solve their writing problem at some point. They must recognize that the writing they have is substandard, that they have writers that have, in some cases, a fundamental lack of understanding of what they're writing about. And I don't know that CFAI has within it the skill set to even recognize that this stuff is wrong. So you have the blind leading the blind on this one. No, I think you get back to published authors in finance, drop the woke shit, drop the ideology. This is finance, and just stick with the finance stuff. Leave the ideology out of it. And I think it can get back to the glory it used to be. But I wouldn't say the bloom is off the rose, but the petals are slowly wilting on this one, right? It's to the point where the new readings, I can't stand them. I look at them, I read them, I think, I don't even want to do this. This is the amount of work I have to do first to fix this reading, the amount of work I got to do to fix it before I can even teach it. I'm not interested. This is way more. This is there, and you're taking out all the richness, all the technical stuff that matters. Well, all of that's disappearing. It's words on pages, and it's not even the right words sometimes, or it's not enough words. So it's the new readings coming in that I look at. I think, I don't have it in me to rewrite this mess. First, I got to rewrite it before I can even teach it. I'm sure they'll get back to they'll find their heart and their soul again. It's just been lost. But it starts with new leadership. So if anyone out there from CFAI is listening, you need new leadership. The path that you've been going on these last few years is the wrong way. Unless I'm missing some incredible strategy along the way. Look at your enrollment numbers pre-pandemic to now, the amount that you're down. You think that might have something to do with it? You think there might be a correlation here? I think so. You should be leaning into the rigor, not leaning away from it, leaning into it. My thoughts, just my opinion. All right. Okay. We'll end here. It is 10:09. My chair is squeaky. I got to find a new chair, but this is the only chair I'm really comfortable in. They don't make them anymore. So I have to go sit in another 50, 60 chairs for 2-3 hours in every store and think, do I want this chair? Can I help you? No. You've been here for an hour. I know. My pizza should be here soon, but you got to live in a chair for a while, right? Before you can buy it. And this chair is slowly dying. All right. Enough about my chair. That's it. Actually, you know what? Before we go, let's just check in, see what's going on in markets. I know you can't really tell much anymore from this time of night. You used to be able to determine flat. We were up, then we were down. Now we're flat. It's just flat. Forex. The yen is stronger. Well, nothing much has changed. Yen is stronger by 0.43%. Peso is weaker by 0.44%. That relationship's pretty solid. Nothing much to see here. All right. I will see you guys next Sunday. Ciao. Where's my end stream? There it is.